Thanks for tuning into Talking Point. I'm your host, Niraj Shah, and it's a flat day for the markets now, or flattened out a little bit, 0.22%. I mean, marginally off from the levels that we were trading at, but the Sensex clearly flattened out. And by the way, the culprit, or the lack of it maybe, but the culprit seems to be Nifty Bank, which is very, very flat, because Nifty IT is doing the hard work today again. 0.41% higher for the Nifty IT. Remember, this is the best performing index in Friday's session too. It was the best performing index for the week. And I think it's starting off well today. So if you look at the 7-day chart of either the Nifty IT for a week, about 5%, and some of the large constituents from a TCS to a Infosys, I presume all of those, excuse me, should be showing some upsides. There is sporadic gains today for companies in the hospitality space, for example. So if you look at Chalet Hotels, BLS International, GMR Airports, everything a lot of businesses connected to travel and tourism. Chalet's come off a little bit, but GMR and some of the others still okay. Though you would argue that most of these businesses seem like they've come off from the highs of the day. So that's one piece to monitor in the session. Then the capital market related plays. So 361 did okay, or is doing okay even now. I believe Angel One started off well. So that's the other one to keep in mind. And there's some strength in specific names. Like for example, NBCC on the con call has spoken very strongly about what they will do over the course of the next 12 to 24 months. And I think that is leading the stock materially higher in the session today. So watch out for that one. Triveni Engineering, and I think sugar stocks have been on a bit of a roll ever since this whole thing about ethanol policy change has come about. So that is doing okay. So that's a few things that you're going to keep in mind. The other stock that is in focus today is Shriram Finance, because a clutch of brokerages are very constructive there. And I get in my colleague Harsh for a very quick perspective on what HSBC, for example, is saying about Shriram Finance. Harsh, good morning.
Good morning, Niraj. As you rightly said, very constructive when it comes to Shriram Finance and Nifty 50 company. 20% plus upside from here, 12-month price target, of course. So a very interesting play of sorts. First off, what they're suggesting is the 2012 to 22 period, lots of hiccups, but now that is firmly behind Shriram Finance. They've come off from some of those woes that they faced, and they've overcome that speed bump of sorts. So that's one piece. The second piece is growth has been extremely strong. The merger between Shriram City as well as Shriram Transport has materially impacted the numbers overall. And now there is a larger focus with regard to where growth is clearly well above growth guidance, at least for Q1 FY25 Shriram Finance. Now, just in terms of how operationally it's shaping up, there's a positive as well out there. What they're suggesting is operational efficiencies will kick in. What you will start to see is as growth comes in, unsecured lending hasn't been a large focus, and therefore credit costs will be limited. And that is the other positive with regard to asset quality as well. Last off, just with regard to ROAs expected to be around 3.5%, ROEs expected to be around the 17% kind of mark, and they're valuing this at 2.1 times price to book FY26. So despite the 21% upside, FY26 valuations don't look very expensive.
Thanks for that, Harsh. Is it financials? Is it IT? What will lead the indices higher? Will the indices move higher from here? Fundamentally, post the earnings season being over, but being one more week closer to a potential Fed action. Mahesh Nandurkar, Head of Research and Managing Director at Jefferies India, joins us right now on the show. Mahesh, such a pleasure talking to you. Thanks for taking the time out. Niraj here, good morning.
Thanks, Niraj. Always a pleasure talking to you.
Thank you, Mahesh. How constructive or not constructive are you, considering that we've ended an earnings season which was ho-hum, if you will, but there is a large macro event on the anvil in terms of the Fed move?
Absolutely. I think there are a lot of macro events that have happened recently, and are could be a few more later part of this current calendar year. And clearly, in the context of where we have come in terms of the market movement over the last 1.5 years, last 2 years or so, which we have been very strong for Indian markets, and rightly so, in my view, given the pace of the economic growth, the relative strength of the economy, and on top of that, the strong domestic inflows that we are seeing, into the markets. In fact, the pace of the domestic flows is really the key driving factor that we've seen that has kept the markets at a higher level. If you look at the current calendar year, we are looking at almost $7 to $8 billion a month. That's the extent of inflows that we are seeing from various domestic sources. Clearly, a very, very high number, in my view. So keeping all these things in the context of high valuation, very, very strong domestic flows that we've seen in the last 7, 8 months of this current calendar year, and the expected, changes, in the global macro, so to speak, I would say that the risk reward, at least from a short-term perspective, say from the next 2 to 3 quarter perspective, doesn't appear that attractive. The long term is, obviously looking quite good.
Mahesh, even if the Fed moves and sounds dovish about policy, that you don't think that will be enough for equities to stay benign or constructive? They may not really rally too much, but you don't think even then it'll be good enough?
Yeah, see, the thing is, see what we've seen, we have seen what happened to the global markets and Indian markets over the last 2 years, during which the Fed has increased the interest rates by almost 500 basis points. If you, go by the traditional, sort of models, a 500 basis point increase in the risk-free rate in the US would have impacted the US equity and the global equity quite negatively. But that did not happen. So I'm not so sure that we can really take a leaf out of the history book and say that if the Fed is going to cut rates, that will be benign for the markets. I don't think we are, clearly following the copybook style response from the equity markets to the potential actions on the interest rate side that have been taken by policymakers. So I would therefore say that from the next 2 to 3, quarters point of view, yes, Fed is definitely one. But then we also saw just a few weeks back, what happened to the Japanese market, right? Although it was a one-day, phenomenon, and a large part of the fall has already been recovered. But that just goes just to show the vulnerability of equity markets to some of the macro developments, and therefore we should not be ignoring those.
Okay, fair call. Mahesh, just if one looks at so the argument that from a longer term perspective that you made is interesting. If I look at it from a perspective of the lens of sectors that have rallied and haven't, and then juxtapose it with the kind of commentary that the companies have given from within that sector, right? Where is it that you find within that landscape risk reward to be balanced? Because the problem seems to be that where growth seems near certain or possible, the pricing in is happening very, very swiftly.
True, absolutely. The markets have been moving very, very rapidly, as you rightly mentioned. There is hardly any time gap between an event happening, between a company surprising, and the stock prices reacting, in a very meaningful way. So from that point of view, I would say that the market is, really kind of, priced to perfection, and several sectors and several stocks, are priced, for that perfection. So that's my whole point. So, one of the earlier statistics that I mentioned of around $7 to $8 billion per month of domestic inflows. And when I say this number, I'm including not just the flows coming in from the equity mutual fund, which includes SIP and non-SIP portion, but also the single stock purchases by individuals, also by the insurance companies. And mind you, this number of $7 to $8 billion a month annualizes to almost $90 billion a year. That's roughly 25% of the annual financial savings of households on a gross basis, one third, on a net basis. Now, these numbers are actually comparable to what we see in developed world. 25 to 30% of savings going into equities is something that we see in developed markets. And to that extent, I believe at least a part of the domestic inflows that we've been seeing appears, unsustainable to me. And now, what can bring it down to more sustainable levels? I mean, there can be, various events that one can think about, whether it is US recession, whether it is, a possibility of some shocks coming maybe from Japan or maybe some geopolitical events. Maybe, there could be some tax related changes and so on. So as I said, it's very difficult to pinpoint what exactly might happen. But I would say that, from a near-term perspective, I see the risk that the domestic, inflows might calm down, might slow down from the current levels. And while there will probably be some compensating factors coming in from the foreign flows, because those have been very weak, in general, the last like 7, 8 months, or even last 12 months or so. So that can be some compensating factor. But net is that, maybe we have to undergo some kind of a time correction, if not actually some kind of a market correction. But yes, after we go through with that near-term adjustments, I think the long-term appears to be quite attractive.
Got it. Okay, Mahesh, stay on. We need to take a quick break, a quick commercial break. We're back from the break and talking about some of the interesting pockets. I mean, as you've seen, IT continues to buzz. As you can see, some of the new age businesses, Ola Electric on a circuit yet again, Zomato up in trade. So some of the new age businesses doing very well. And Jefferies sees limited room for upsides in IT services at least. So we try and talk to Mahesh about some of these nitty-gritties of within this whole index benchmarks. From amongst themes and sectors, I was looking at some of the research that you guys have published recently, right? And amongst the things that were done last week was this whole note wherein on IT, wherein he was talking about how there is limited scope for a positive surprise. You prefer TCS, Infosys, and maybe some of the larger ones. Now, why is that the case? Is it because the US economy is not necessarily firing on all cylinders, or is it because you believe that the surprise is also a factor of the price move that goes behind a stock, and some of these stocks have moved from the June lows?
Yeah, true. So as we discussed, earlier, the results coming in from the IT services companies for the June quarter were maybe a tad better, not a whole lot. And that kind of, that level of positive excitement got priced into the stocks very, very quickly, maybe, just like a few days' time. But, if one takes a step back and, move away from these recent moves that we've seen, in the stocks and the results. But by and large, Neeraj, what we're clearly looking at is the scenario where the possibility of a US economic slowdown is now more today as compared to what it was 3 months back or 6 months back. And that's why, there is this chatter about the rate cuts in the US. So, I see that there is some element of excitement around the IT services sector due to rate cuts. But what I would say is that one needs to go one level deeper and see what is the reason why these rate cuts are being talked about, at a sort of, much more higher probability today. And the reason is that of an economic slowdown or a possibility of, or a higher possibility of, US recession. And those things are definitely not, that positive, a thing from the demand perspective. So that is, clearly, one thing to keep in mind. Secondly, now when we talk about the rate cuts, it usually impacts the financials and the banks, in the US in a negative way because of the margin pressure, etc. And BFSI segment is one of the large, is one of the large sectors in terms of the demand contribution to Indian IT services. So from both these standpoint, we don't really see any big reason to be too excited about. Yes, the IT services sector looks like a defensive sector. It is one of the sectors that hasn't really done that well in the last, say, 8 to 12 months or so. And there is that element of sector rotation that will probably be, playing out. And to our mind, it has already played out to some extent. So beyond that, we don't really see any big fundamental reason to be too bullish on IT services here.
Okay. What about some of the, I mean, not IT services, but tech-related businesses? I mean, Ola Electric's debut, or rather performance post-debut, stuff that dreams are made of. Zomato continues to see some record performance from Blinkit and some of the others. And a lot of these tech-related businesses, right, PB FinTech. So I'm just using these as example for viewers to understand. But Mahesh, I'm just trying to understand from you that new age tech or tech usage or companies which use tech to build B2C businesses. How do you see some of those? Because the market is now pricing them very, very strongly and very, very richly.
Yeah, that is true. But we clearly like some of the stocks in this space, this e-commerce, this tech-enabled sectors, that you spoke about, in the food delivery, the quick commerce related businesses, because these are, ultimately the new segments, relatively sort of relative new segments, on the markets. And in general, what I would say is that from the broader market perspective, the sectors that have done well, over the last 10 years or so, need not be the ones that would do better over the next 5 to 10 years. Some of these new emerging sectors, be it these tech-enabled, the e-commerce sectors that you spoke about, or even some of the green energy or energy-related sectors, which haven't really done that well in the last 10 years. But I think some of those stocks have done pretty well in the last 1 or 2 years or so. And I'm going to come back to our favorite theme that we have spoken about, which is the investment cycle, which is not just real estate, but other capital goods, infra, and so on. So these are some of the sectors that have already done well, on the markets in the last, say, 1 to 2 years or so, and maybe they are in for a breather. But if you were to ignore that near-term, say, 6 months to 12 months kind of a period, and if you focus on, let's say, 3 to 5 year period, I still believe that these e-commerce related, these energy related, real estate and investment cycle related stocks and sectors that will probably do much better than the market from a longer term perspective. From a near term perspective, yes, I do see headwinds and a risk of underperformance there.
Got it. Mahesh, one final question. I wanted to talk about financials at length, but there is paucity of time. So I'm going to focus on one particular subset of financials, non-lending financials, which is insurance. Now, past history would suggest that these stocks, if you look at it on a CAGR basis since listing, haven't really, I mean, yes, they've generated wealth, but not really created such high wealth that it deserved the kind of investments. Now, maybe the street was not quite adept at valuing these companies, has now grown adept, what have you. I would love to understand, how do you think of life insurance or general insurance as a pocket where you may or may not want to invest in?
No, insurance is definitely a sector that we quite like. The non-lending financial overall space looks attractive, but even within that, insurance definitely looks attractive. The other part of the NLF or the non-lending financials is the capital market related plays. Once again, the capital market related plays have done quite well in the last 12 months or so. And I do see some risk of underperformance going ahead into the next 6 to 12 months. But beyond that, the capital marketplace should pick up once again. But in the interim, we definitely believe that life insurance, particularly as a sector, it's as a sector that should do well over the next 6 to 12 months. And I believe the sector rotation, which is also playing out to some extent, should play out in favor of the insurance sector here. So yeah, we are overweight on insurance sector.
Okay. Okay, overweight on the sector. And just extend that conversation, Mahesh, general insurance, because that seems to be a consensus. Life insurance, at least there's some people who are, some who are not. In general insurance, almost everybody seems to be constructive. So is this a multi-year theme, and should people investing in this really invest with the long-term view in mind, general insurance stocks?
I think both general insurance and life insurance appear to be attractive long-term themes for sure. There is no doubt in my mind. And in terms of the penetration levels, both sectors are at a low level at this point in time. And clearly, the financialization of savings, slowly, the households are moving away from the attraction of gold and looking at, the other, financial, investments. And, clearly, especially after COVID, the life and the general insurance segments have, become a greater part of an average, individual's portfolio. I definitely see a much better long-term potential for both these subsectors within insurance.
Got it. Mahesh Nandurkar, such a pleasure talking to you. Thanks for taking the time out. And, this is somewhere around Independence Day. Hopefully, we talk once more around the festive season ahead of Diwali or around that. But thanks so much for joining in today.
Thank you, Niraj, for having me here. Thanks a lot.
The pleasure is ours. Well, that's the view from Jefferies. And on a note that it's been a sobering morning because it seemed primed for an uptick. Somehow it's flattened out completely, courtesy banks, which are dragging the indices slightly lower, but no alarm bells. Just that the broader markets too are seeing a clutch of stocks which are correcting quite a bit. V-Guard is down, for example, 7%. Hinzink sulks, another 4.5% down for that one. Kalyan Jewellers down about 3%. Jupiter Wagons is down about 2.5% lower. There is Carborundum, Schaeffler, Data Patterns, a clutch of stocks which are looking slightly wobbly. But with that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in to the episode.